Hi everyone, welcome back to the Smart Money Stack. I'm Rameez Ali, certified blockchain expert, senior executive in the crypto space, and author of Programmable Finance, the future of money in a tokenized world. Today we're diving into a powerful statement from Tom Lee of Fundstrat. On the Compound and Friends podcast, he said that banks that embrace tokenization could be re-rated like tech growth stocks. That might sound like a throwaway line, but it's not. It gets to the heart of how programmable finance is reshaping the financial system. So today we're going to break this down fully. We'll talk about what tokenization actually means for banks, how it changes the economics, where we're already seeing it, the risks that come with it, and why it might truly unlock tech-like valuations. Let's talk about what the context is. Tom Lee's background is equity research. He thinks in terms of how markets value companies. When he says banks could be re-rated like tech stocks, he means investors could fundamentally change the multiple they assign to banks. Today, most banks trade at a fairly low multiple. Investors see them as slow growth, capital heavy, highly regulated, and cyclical. Even greater banks rarely get beyond modest valuations because the market assumes the business is capped. Now compare that to tech. Tech companies get high multiples because they scale. They can add millions of new users with little incremental cost. They create new business lines quickly. Investors reward them for their growth runway and their ability to dominate markets. Tom Lee's point is that tokenization could make banks look more like that. If banks adopt tokenized deposits, programmable assets, and stablecoin rails, they don't just become more efficient. They open up new possibilities that make them scalable. That's the seed of tech-like re-rating. So what exactly is tokenization? At its core, tokenization is taking a real-world asset like a bond, a stock, or even dollar deposit and issuing it as a digital token on a blockchain. That token represents ownership of the underlying asset. Why is this powerful? Because once it's on chain, it becomes programmable. You can transfer it instantly, embed rules, fractionalize it, and interact with it in smart contracts. Suddenly, money isn't static, it's active. It can carry conditions, react to triggers, and execute logic automatically. In programmable finance, I explain this as the shift from money being a ledger entry to money being code. Tokenized money doesn't just sit in accounts, it moves when conditions are met. It can pay taxes automatically, enforce compliance instantly, or distribute dividends without human intervention. For banks, this means transforming their core business. Deposits become programmable tokens, loan becomes smart contracts, securities become digital assets that can settle instantly. That's not just efficiency, that's a new financial architecture. Let's connect this to bank economics. Banks make money in a few core ways: taking deposits, lending, managing payments, and offering investment services. In the current system, each of those is clogged with friction. Payments take days to clear, lending involves paperwork and reconciliation, investment settlement requires custodians and clearinghouses. Each step adds cost, delay, and risk. Tokenization removes those layers. Imagine cross-border transactions settled instantly without SWIFT or correspondent banks. That cuts costs massively. Imagine programmable lending, loans that automatically adjust terms based on data, that margin call collateral in real time, that reduce default risk with code. That improves efficiency and safety. Imagine tokenized deposits that can be moved instantly between jurisdictions, plugged into programmable savings product, or integrated with digital wallets. That creates new customer experiences and new revenue streams. The result is banks doing more business with fewer costs. That's the definition of scalability. And scalability is what makes investors assign higher multiples. Think of it this way. If a bank can handle 10 times the transaction flow without adding headcount, that looks like a tech platform. That's why Tom Lee said what he said. Tokenization flips banking economics from linear growth to exponential potential. Let's look at history for context. Bank used to be physical branch networks. The advantage was geographical reach. Then came digital banking. Suddenly, mobile apps allowed banks to reach millions without adding branches. That improved efficiency, but it didn't fundamentally change valuation multiples. Bank was still seen as capital heavy. Compare that to tech. Companies like Amazon or Google scaled globally with digital infrastructure. Their cost per new customer was almost zero. That's why they got valued at 20, 30, or even 40 times earnings. Tokenization is the first shift that can push banks into that category. It takes their traditional balance sheet business and makes them programmable, global, and scalable in a way that looks more like cloud platforms than local utilities. Let's discuss some real-world example. JPMorgan has its Onyx platform and JPM Coin. They're moving billions through tokenized deposits. Their work on blockchain-based settlement is already providing the cost and time advantages. SBI Holdings in Japan just announced a platform for 24/7 on-chain trading of tokenized stocks with instant settlement. This is programmable finance at industrial scale. Wyoming launched the Frontier stablecoin, showing how even governments are exploring programmable money. Stripe just expanded stablecoin payments in Asia. That shows fintechs are not waiting for banks, they're pushing ahead. The lesson here is clear. Tokenization is moving from experiment to infrastructure. The rails are being laid down, and banks that ignore them will lose ground. Those that embrace them could change the entire valuation story. Let's talk about the risk and challenges. Of course, there are challenges. Regulation is one. Custody and compliance for tokenized assets are still evolving. Integration is another. Core banking systems are not easy to rewire. Capital markets need standards and interoperability. There's also competitive risk. If banks move slow, fintechs and crypto native companies will capture the programmable finance opportunity first. That could leave banks in a defensive posture rather than reaping tech like valuations. But here is the pattern in finance. Once clarity emerges, adoption accelerates. We saw it with mobile banking, we saw it with cloud, the same will happen with tokenization. Let's step back and see why this matters for investors. Investors care about re-rating because it changes the value of their holdings. If banks get priced like utilities, they're capped. If they get priced like tech, the upside is massive. Tokenization could make banks look like platform businesses. Think about Apple's App Store. Each new app created more revenue without huge new costs. Tokenized banking could do the same. Each new programmable product at scale without massive overhead. That's why Tom Lee's comment is so powerful. He's not just making a throwaway prediction. He's pointing to a fundamental shift in how the market could value financial institutions. In closing, let's bring it back. Tom Lee said that banks that embrace tokenization could re-rate like tech growth stocks. And he's right. Tokenization turns static assets into programmable ones. It makes banks more efficient, more scalable, and more innovative. It's not without risks, but the upside is enormous. And that's why I believe programmable finance is not just the future of money, it's the future of financial institutions themselves. I dive deep into this in my book, Programmable Finance, The Future of Money in a Tokenized World. If you want to understand how these trends play out, that's the place to start. Thanks for listening to the Smart Money Stack. Make sure to subscribe so you don't miss future episodes. And remember, the future isn't just digital. The future is programmable. Till next time, this is Rameez Ali.